In this video, we're going to go into the math of Palantir's valuation. Is this just FOMO or is it reality? Is this price actually justified? And what do we do with the stock? Well, I'm Henry Chien. I'm an equity research analyst and CFA charterholder, and I'm an educator to investors. So now let's go into the background of Palantir and why you should care. Well, first off, the stock has 6x'd. It was $20 last year, and now it's $120 a share. This company makes software. So it provides a platform for, first it was governments, now it's commercial enterprises to use data analytics in their organizations. The thing is with the commercial side is that these companies are using Palantir's platform to integrate AI. So Palantir's business is now at the forefront of this wave of money coming into software to enable AI for these companies. So how expensive is Palantir really at this point? Well, one of the ways that we can look at it is just from the market cap. If we take the price per share and multiply it by the number of shares outstanding, that tells us the market value of the company. It's currently $260 billion. Now, in order to understand whether it's expensive or not, we need to compare it with other companies. A company like Adobe is $200 billion in market cap. A company like ServiceNow, similar company, they do enterprise workflow management. That company is $200 billion in market cap as well. But the thing is, Adobe makes about $23 billion in revenues through Photoshop, Adobe Acrobat, and ServiceNow makes $13 billion of revenues from all their contracts that they're doing with their companies. Palantir only makes $3 billion in revenues for this year. So that we have to start thinking about it from a multiple perspective. Now, here's where things get really crazy. If we're looking at it from a multiple perspective, Palantir's revenue multiple is basically 90 times this year's revenues. Now, most of these enterprise software companies, even if they're AI related, trade between 10 to 20 times revenues. If we look at the price to earnings ratio, here it gets really crazy. Palantir's price to earnings ratio is 200 times versus the normal 30 to 50 times for these AI or software related companies. So it's got the highest multiple of all the comps, the comparable companies, even AI-related companies. So that tells you that the market is pricing something else. So why did Palantir's stock explode in particular? Well, the market is starting to understand the growth potential of the business. The revenue growth rate of the company has accelerated from a 20% level to now a 35% level. What's happening is this commercial business is starting to grow so rapidly, it's bringing up the overall growth rate. You can see it also when they report the total amount of deals that they're signing. That's up close to 60%. And also in things like the net dollar retention, which is 120%, which shows their existing customers are now signing on to buy new software. That's what's increasing the net revenue retention as well. Now, the thing is with Palantir as well, is that they've grown their margins. So they're also making a ton of profit on all that business. The operating margins are 40%. And a lot of it is going straight down to free cash flow. What's been happening here as well is that Palantir, because it has a small sales team, they've also been able to figure out how to grow and do it very profitably. Basically, this is a really, really great business to own, especially because it's starting to enable AI and all the spending that comes with it. All these numbers are really showing investors that it's solved some of the biggest problems that you see in software companies. They've been able to, one, show a ton of growth, and two, also show a ton of profits. There's something called the rule of 40 that a lot of software investors use, which is you take the growth rate and then you add it to the margins, because then when you get to a rule of 40, that is a screen to show that this company is a good software business. Palantir's rule of 40 is rule of 75. Their expected growth for this year is 30% plus revenue growth, plus a 45% operating margin. So it's a rule of 75. When you layer on the top the fact that this has such a big addressable market opportunity, all the spending related to AI, it's no wonder that this business is clearly a business you want to own. So what is the market pricing in? Well, generally, a company can start to get a higher multiple when it has better growth, i.e. more revenues, and two, that there's guaranteed profits on those revenues, and three, that there's just a lot of certainty for an investor. So the way to understand valuation here is to look at the expected growth of Palantir. When we look at the deals that they've signed plus any remaining performance obligations, so meaning the remaining value on their contracts left to be delivered, they have about $10 billion in total deals plus existing revenue. So when we look at it from $10 billion, assuming all those revenues are going to come in the future, now the company is trading at about 26 times revenue multiple. So now it's looking pretty reasonable. So what that's telling you is that the market has essentially priced in the next 5 years of growth for the company, because each of these contracts takes about 1 to 5 years. So the market has priced in all of these contracts as guaranteed. And so now this is why the company is basically trading at that 10 to 20 range for a software company. So we use revenue multiples for software companies at first, because when software companies are first starting out and they're first growing, they usually are not making many profits. So the best way to compare them, or the only way, is a revenue multiple. And there's a number of assumptions that are baked in. One is that these revenues are expected to be recurring, because a lot of these software companies are subscription-based. And the second assumption is that this is ultimately going to turn into some profits. So the second layer of analysis is we need to start to think about what is the expected profits that are also being priced into the stock. We can look at it from either free cash flow, so the cash that's being generated, or the earnings. That's just the profits that are being reported by the company. So if I value it based off cash flows, essentially what's being implied by this current price level of about $115 a share in stock is if I take this $1.6 billion that they expect to generate in free cash flow this year, and I grow that by 35% every year for the next 10 years. And then by the end of 10 years, that free cash flow is close to $20 billion in free cash flow. I apply a multiple of about 30 times, which represents a normal multiple on free cash flow for a large tech company, to get that value. I sum up all the cash flows plus that end value and then discount it by 10 years. So why do we discount? I'm discounting it by a 10% rate, because one, that represents the cost of capital usually for a company on the stock market. The other way you can think of it as this is the required return on cash every year that investors demand if they buy stock in the company. So I discount that back to 10 years, and that's how I can get to $115 a share. The other way we can start to think about what's implied in the price is looking at it from an earnings perspective. So I start off with they're expecting to generate $1.7 billion in profits or operating income this year. Now I got to take away the tax. So assume a 21% tax rate. That implies about 1.34 in net income. Now taking the shares, which are about 2.53 billion in shares, that works out to about 53 cents in earnings per share. Now I got to incorporate the growth as well. So let's assume for the next 5 years, this company will grow its earnings per share at 32%. Now, why 32 and not 35? Well, the thing is with Palantir and a lot of software companies, they're paying out shares as compensation to their employees. So that'll raise the share count. So that will dilute the earnings per share because you raise the number of shares. And so it should slow down growth a little bit. So by using a 32% rate every year, you get to about $2.12 in earnings per share by year 5. Now we can use a 55 times multiple, which is a normal multiple for a company that's growing at about 35% in terms of its long-term growth rate. Now the way that I like to think about price to earnings multiple is if I take a 10 times price to earnings multiple and assume the company is not growing, then that company will essentially pay me back in 10 years if I just collect up all the earnings. So when a company is growing, then obviously that payback period would be shorter. So a 55 times multiple is the equivalent of a 10 times multiple with a 35% growth rate, right? Because that payback period with the 55 times multiple is also 10 years. So using a 55 multiple times the $2.12 in earnings per share, we're getting also to a $1.16 per share stock. So now if we're thinking about what the price is implying from the earnings or profit perspective and free cash flow perspective, basically the market is assuming that Palantir will grow in the long term at least 35% every year in free cash flow as well as earnings per share. And it's also assuming, because of that, profit margins are expected to be stable. And then the revenues that they sign on will be recurring, so that each time they sign on new revenues, it would just be stacked on top of each other, generating all those profits. So now let's go into what are investors missing? What are the bears missing, the ones who are telling you to never buy the stock because it's too overvalued? Well, the first thing is that if you're using a simple next 12 months valuation, like that 90 times revenue multiple or 200 times price to earnings multiple, you're not taking into account, one, the expected deal value. So we know that there's visible revenue based on the deal values that they're reporting. And two, it's not really considering the growth potential of this new commercial business. Now, we know that it's growing very fast, but the thing is with AI is that this is also expected to be a really big market. So IDC, it's a research forecasting firm, they expect AI platform spending to reach about $150 billion in 2028 and growing at a 40% rate. So that aligns with what Palantir is seeing. Now, we can also, if we want to incorporate what they can get from the government side, they were expecting that their addressable market is $120 billion back in 2020. So if I grow that by about 14, 15% every year, that gets us to about $230 billion in total potential market. Now, if we assume that Palantir can maybe take 20, 30% of market share of that market, now we're talking at least a $20, $30 billion company, right? So that's a lot of revenues for the company. And we also have to consider the fact that they're also making a lot of profits. If they can continue with their sales model, which they're using boot camps to sign on enterprises to very quickly show them the benefits of the product and then signing them to get on deals, well, then we can start to have a case for this high multiple stock, the company starting to generate profits. And as those profits grow, that multiple gets lower. That's happened a lot of time for software stocks. At a high level, it's like thinking, well, this company can be like the next Oracle or the next Salesforce, right? And if we assume that it gets to those 30 billion types of revenues and we apply the same multiple as those large cap companies, well, a 30 billion revenue times a 15x revenue multiple, well, that gets you to about $180 stock. If we say use 18 billion in free cash flow, and then use the normal 30 times free cash flow multiple of one of these large tech companies, now we're getting to about a $210 per share stock. So we clearly have room to go to 180 to 210. Now, so what are the bulls missing? What is everyone who's so excited about this stock missing when it comes to this type of analysis? Well, the thing is, when you have a really high valuation, we're assuming $30 billion in growth in revenues, we've pulled forward all that growth. This is going to take 10 years for Palantir to achieve. It currently has $3 billion in revenues. Even if we grow at 35% every single year, which is a high growth rate, it's going to take 8 years. And that's how long it's taken for companies like Oracle or for Salesforce. Now, maybe they can grow faster. But the thing is also, if we think about the valuations again at a high level, Palantir has $260 billion in market cap right now at this price. Salesforce is $320 billion. Oracle is $480 billion in market cap. So even if Palantir can get to be those type of companies, if it's valued the same, well, that translates into about a $140 per share stock price up to a $210 per share stock price. So meaning your upside, if it gets to the size of those companies and is valued similarly, is only 20 to 80% upside. So the thing is, high valuations are great if you owned it previously, but what it also does is it exposes you to more risk. Now, the risk here is if the company, for whatever reason, decides to grow at a slower rate. Now, obviously, if it's growing at a slower rate, then it's going to take longer to get those revenues and longer to get those profits, which would take down the valuation. Now, that's exactly what happened in the dot-com bubble. A lot of these tech companies are trading at super high valuations. There was a ton of growth, a lot of capacity being built, and then the profits didn't really show up. So then what happened was these valuations started to compress. Like the valuations were so high that the profits weren't able to actually grow to meet those expectations, which is why 18 to 20 times was actually kind of the peak in terms of a sales or revenue multiple for these software companies, because it's so hard to meet expectations when you're having such a high multiple. Now, what actually happens if growth slows and the multiple collapses because it's not meeting those expectations, Well, investors were stuck with a lot of expensive stocks that took a long time to recover. So if you bought Oracle back in 2000s, it was 27 times sales. This company made about 10 billion in revenues. It took 17 years for the stock to recover. Amazon bought at 19 times sales. It was making 3 billion in revenues. That took 9 years to recover. Adobe, 13 times sales in 2000. Now this company was making 1.2 billion. That took 7 years to recover. So you can see that as the valuation grows, if that valuation ever comes down because the profits aren't being met in terms of those expectations, it takes a long time for it to recover. Now we've seen it already with a little company that you probably know of is Tesla. So Tesla reached $1 trillion in market cap in 2021. So at that time, that was 18 times revenues. Now everyone thought that was super expensive because, well, that was more than the next 10 companies, auto companies combined. And they were saying, well, they have a ton of cars coming. And that's what happened. The company now makes 100 billion in revenues from its car sales. So now it's a 10 times revenue. But the thing is, it's still a $1 trillion market cap. That peak from to today took almost 4 years to recover because the valuation was so high. So the biggest risk that investors need to watch is that this company is not going to meet its expectations. Whether that's maybe they're having a slowdown in signing new customers or getting renewals from existing ones, or maybe that there's just a general slowdown in spending in AI. Maybe it just happens to be a one-time for the next 2 years spending boom in AI software. So any kind of moderating growth, it will be a risk for these type of valuations in the stock. And so basically the biggest risk you're looking out for is if there's any signs that companies are starting to cut back on their spending on AI. So what to do with the stock? So I think that this stock could probably get to 160, 180, just using the math of 30 billion times a 15 times revenue multiple. That's what I think can be the upside. Now, I think the stock can also get easily down to $60 or $70 just using a 10 billion estimate with the 15x revenue multiple. So that would be the downside. So when I look at it, I see a stock that could have potentially 20 to 30% upside and potentially a 50% downside. So I can't really buy it at this type of risk reward levels. But the thing is, I do think it's a really great business. So I would love to own this company. What I'm doing is probably going to wait to see if it maybe gets down to 80 or so, if say that valuation compresses, then I would easily start buying this stock. If you're a holder already and you've bought it at a good price, well, that's great. So I don't think that there's too much for you to do. You can just keep riding the wave, but just understand that the math of the valuation, even if it's going to get to be like Oracle or Salesforce, that any type of moderation and growth rate might lead to a 50% contraction in the stock. But you just have to be aware of it. Doesn't mean you need to sell it, just understand that can happen. And a lot of the upside is most likely priced in. So I hope that was a helpful breakdown for you. Let me know what you think about Palantir in the comments. Like and subscribe. You can hit the bell so you can tell the algorithm if you like this video. And thanks for watching, and I'll see you in the next video.